see the market open lower this morning, and that was a result of some negative leads that we received from the US overnight. All indices over there were lower as a result of some negative earnings that did come through. However, at around 11:30 a.m. today, we did see our market starting to pick up, and it did trade higher since that time, and we did end up closing in the green, so it was very nice to see. We did see Westpac's consumer confidence data coming out. It was down 6.8%, but I think the market did pick up after that as a result of that number being slightly better than expectations. Yesterday we saw ANZ Roy Morgan's data coming out saying that consumer confidence was down around 14%. So I think the Westpac data that came out today was a little better than expectations, and I think that investors liked that, and then the market picked up after that. We also saw some of those Australian wage data numbers coming through, which were fairly in line with expectations. But overall, the best performing sector today was that telecommunications sector. It was up 1.1%. That was led higher by Telstra, which is still trading at high levels at the moment, and it was also led higher by staples and energy as well. We did see energy having quite a nice turnaround. The sector that was trading lower though was materials. That ended up being down around 0.7%. That was a result of receiving some lower commodity prices through overnight. Iron ore, copper and nickel were all lower, and as a result we did see those iron ore miners taking another hit today. But overall it was a positive day on today's session.
Yield, Leanne, continue to be a focus for investors?
It certainly does. It does look like these yield plays are coming into focus, particularly Telstra. We have seen yesterday it reached a 9-year high, and it is trading higher again today. I do think this is for a couple of reasons. Firstly, the Reserve Bank has indicated that they are going to be keeping interest rates low for some time, and obviously what that means for term deposits, they are going to be lower as well, so investors are jumping into these yield stocks. Not only that though, the impact of the budget, we know investors have been viewing this as a horror budget, so it's the confidence that has instilled in investors is negative. So again, I think investors are jumping back into those yield plays. And finally, this consumer confidence number that has come out today, which is negative. I think all of these factors combined really is allowing investors to jump back into those high yield stocks. As I said, Telstra is trading at 9-year highs at the moment. Our outlook on Telstra is fairly positive. We think they have strong operating momentum in place, along with that high dividend yield, but it does look fairly expensive at the moment. But nonetheless, we do remain positive on it, and as well the banks. We have been seeing some of those banks trading at record all-time highs recently as well.
Where does this leave Woodside? I mean, there have been question marks over the growth in earnings and where the growth for this company is going to come from, and many pointed to Leviathan. Without that, does it become an issue?
Despite the Leviathan deal falling over today, I still do think Woodside has some strong underlying fundamentals. Back in April last year, we saw in fact that the company increased their dividend payout ratio to 80% from 50% as a result of Pluto moving from cash flow negative to cash flow positive production. So overall, we do expect that the company will be able to sustain that 80% payout ratio up until around 2020. And that's a result of the company having a strong balance sheet, so they have relatively low net debt. We're also continuing to see some higher oil prices coming through, but as well we're seeing some of their growth projects which are looking like they are delayed, which results in reduced capital expenditure. And obviously today's Leviathan project that has fallen over could free up some more cash flow there as well. So I think really the question now is going to be whether they're going to use that capital to pay out a special dividend to shareholders, or whether they are going to invest in growth projects. We are of the expectation that they are probably going to focus on those growth projects. We expect that they have about $2.5 billion to spend in merger and acquisition activity, and as well as maintaining that 80% payout ratio. And we do estimate production will reduce by around 5% from around 2016 onwards. So we know that Woodside does need to start investing in some potential growth projects going forward. We know their strategy day is out tomorrow, so it really will be all eyes on that to hear more out from the company.
Today, Leanne, some rather disappointing trade numbers to say the least.
They certainly were, James. Adelaide Brighton was closed lower, about 5.9%, and it did come out with some disappointing results from that AGM. Firstly, looking at their lime sales volumes, they are likely to be down by about 5% in 2014. But not only that, they indicated that their net profit guidance for 2014 was going to be in line with 2013, where we did see it drop by about 1.2%. In fact, but that doesn't include any of those Birkenhead production issues or a restructure charge of around $4 million. So we could potentially see net profits falling even further. And I do think that investors were disappointed with this result. I suspect they were probably expecting that net profit would be higher than 2013. Nonetheless, looking at the outlook for the stock, we do still remain very positive on the outlook of the building sector in general. We know those building approvals are running at 3-year highs at the moment, so we do think there is going to be a sustainable recovery in residential housing construction. We know Adelaide Brighton is reasonably leveraged to a recovery in residential construction markets. Around 30% of their revenues are derived from this area, and it does look like it is a bit of an underperformer in comparison to its peers. If we look at going back to the beginning of last year, Adelaide Brighton's been up about 15% in comparison to AV Jennings, which is up about 65%, CSR up 68%, and Dulux up 48%. So we do think it is trading at a discount to its peers, and we do remain fairly optimistic on the outlook for the stock as well as the building sector.